Welcome back to the Daily Crypto Roundup. It's great to have you with us again today. Whether you're listening on the way to work, traveling, on shift, or just keeping an eye on the markets while everything else carries on around you. As always, we're here to cut through the noise and give you the actual stories moving crypto today, with real names, real data, and real context, not just opinion. Today's episode matters because while the market still feels subdued on the surface, there has been no shortage of genuine news. We're seeing key price levels tested, institutional forecasts being revised, major corporate Bitcoin purchases confirmed, fresh regulatory signals coming out of the United States, and once again, a string of real-world crypto crime cases making headlines in India. All of that tells us something important about where crypto is right now. Not where people think it should be, but where it actually is. Before we get into the stories, let's start, as always, with the top 10 crypto prices as they stand today. Bitcoin is trading just under $88,000 after briefly testing the $90,000 level earlier today. Ethereum is holding around $2,900. Binance Coin is trading near $850. Solana is sitting around $125. XRP is trading close to $1.86. Cardano is holding near 37 cents. Dogecoin is trading around 12 cents. Polkadot is hovering at $1.86. Chainlink is trading around $12.51. Tron is holding near 28 cents. Now let's get to the stories. Our first major story centers on Bitcoin briefly pushing above the $90,000 level earlier today before pulling back. This move was widely reported across market desks and was not driven by a sudden surge of bullish news, but rather by thin liquidity as traders tested resistance levels. Analysts noted that the break above 90,000 was short-lived, and price quickly retreated once selling pressure emerged. This behavior has been framed by analysts as a liquidity-driven test rather than a conviction move. Several desks pointed out that year-end conditions mean relatively small orders can move price more than usual. What matters more than the spike itself is what happened next. Bitcoin did not collapse. It returned to its previous range, reinforcing the idea that the market is consolidating rather than breaking down. That view was echoed by Alex Thorne, head of research at Galaxy Digital, who commented that Bitcoin is currently trading like an asset waiting for direction, rather than one in distress. Thorne noted that despite favorable policy narratives earlier in the year, Bitcoin could still finish the year with a relatively muted annual candle, highlighting how sentiment and structure can diverge. Another key data point today is the broader crypto market capitalization, which slipped slightly over the past 24 hours, but remains comfortably above the $3 trillion mark. This minor pullback reflects uneven trading activity, rather than any widespread exit from the market. Analysts have been careful to point out that small declines in market cap at this stage of the calendar often reflect positioning adjustments rather than panic selling. On the institutional side, one of the most concrete stories today comes from Strategy, formerly known as MicroStrategy. The company confirmed a fresh Bitcoin purchase totaling just under $110 million, adding more than 1,100 Bitcoin to its balance sheet at an average price just below $89,000. This purchase reinforces the company's long-standing strategy of using Bitcoin as a treasury reserve asset. While this is not a new narrative for Strategy, the timing is important. The fact that corporate buying continues even during periods of consolidation sends a very different signal to the market than speculative retail trading. It shows that at least some large players remain comfortable accumulating at current levels, rather than waiting for dramatic pullbacks. Alongside corporate activity, institutional forecasts have also been updated today, and this is where named analysts really matter. Jeffrey Kendrick, global head of digital assets research at Standard Chartered, revised the bank's Bitcoin outlook for 2026. Standard Chartered trimmed its previous target, citing slower than expected corporate treasury adoption and a greater reliance on exchange-traded fund inflows to drive future demand. Kendrick emphasized that while the long-term thesis for Bitcoin remains intact, the pace of adoption has become more measured. In plain terms, institutions are still interested, but they are not rushing. That distinction is critical, and it helps explain why price action feels controlled rather than explosive. This cautious tone contrasts with views from other corners of the market. Analysts at JPMorgan have highlighted Bitcoin's changing relationship with traditional safe haven assets, particularly gold. JPMorgan strategists have noted that Bitcoin's volatility has compressed significantly compared to previous cycles, potentially making it more palatable as a portfolio diversifier, but only if macro conditions stabilize. What this tells us is not that analysts agree, but that uncertainty itself has become a central theme. And that uncertainty is reflected not just in price, but in behavior. We are going to take a quick break here for a word from our sponsors. Don't go anywhere. We have lots more to get through. Another important development today comes from the regulatory side. The Financial Accounting Standards Board, known as FASB, confirmed that it will begin work in 2026 on how crypto assets and certain stablecoins should be treated under accounting standards. This may sound technical, but it matters enormously for institutional adoption. Clear accounting treatment reduces friction for companies considering crypto exposure. It doesn't guarantee buying, but it removes one more reason not to. This is the kind of slow, structural development that rarely moves markets overnight but shapes them over years. Market structure was also highlighted today by a brief wave of short liquidations, triggered when Bitcoin pushed above $90,000. Roughly $100 million in short positions were wiped out in a matter of hours before price retreated. Analysts tracking derivatives markets noted that leverage remains present but controlled, suggesting traders are cautious rather than reckless. Now, one of the more interesting DeFi stories today involves Hyperliquid, which has unstaked around 1.2 million HYPE tokens ahead of a scheduled team vesting event set to begin on January 6th. According to details shared by the project, this unstaking is part of a previously disclosed vesting schedule and marks the start of a monthly distribution that will continue over the next 2 years. The tokens being unstaked represent roughly a small fraction of the total HYPE supply, but the timing still matters because token unlocks can influence short-term market behavior. Hyperliquid's team allocation accounts for just under a quarter of the total token supply, and the project has said that these releases are designed to be gradual and predictable, rather than sudden or disruptive. The first tranche becomes available on January 6th, with additional unlocks scheduled on the same date each month moving forward. Token vesting events like this are often watched closely by traders, because newly unlocked tokens can add selling pressure if holders decide to take profits. At the same time, Hyperliquid has pointed to measures such as ongoing buybacks and previous token burns as part of its approach to managing supply and supporting long-term stability. The key takeaway here is not that a sell-off is guaranteed, but that supply dynamics are changing in a transparent and scheduled way. For traders and investors, that makes this a date worth marking on the calendar as the market heads into the new year. Now, while much of the discussion so far has focused on institutions and macro narratives, today's news cycle also included a series of stark reminders about the risks faced by everyday users, particularly in India, where multiple crypto-related fraud cases made headlines. One of the most widely reported cases involves a software engineer from Hinjawadi in Pune, who alleged he was duped of approximately 34 lakh rupees after being promised 40% returns on a crypto investment. According to police reports, the victim was lured through online platforms and gradually persuaded to transfer funds before contact was cut. In a separate case from Rajkot, a businessman claimed he lost more than 13 lakh rupees after being promised monthly crypto returns ranging from 3 to 30%. When he pressed for repayment, he alleged he was threatened, prompting him to file a formal complaint. Authorities are now investigating the individuals involved. Another case that drew attention today involved a railway locomotive pilot, who reportedly lost 24 lakh rupees after being targeted in what police described as a digital arrest scam. The victim was allegedly coerced by fraudsters posing as officials and instructed to transfer funds under the guise of a money laundering investigation. Indian police also announced the arrest of multiple individuals linked to a cybercrime network accused of routing scam proceeds through stablecoins and transferring funds to overseas entities, including firms in China. Investigators stated that the operation spanned multiple states and involved mule accounts, highlighting the industrial scale of modern crypto-enabled fraud. These stories matter because they cut through market abstraction. They remind listeners that while institutions debate allocation models and analysts revise targets, real people are still being exploited by scams dressed up as crypto opportunities. It reinforces the need for caution, education, and skepticism, especially when returns sound too good to be true. As we move toward the end of today's roundup, it's worth stepping back and looking at what ties all these stories together. Bitcoin testing resistance without breaking down. Institutions adjusting expectations rather than abandoning the space. Corporations continuing to accumulate quietly. Regulators laying groundwork instead of cracking down. And, at the same time, persistent issues around fraud and misuse. This is not a market in collapse, and it is not a market in euphoria. It is a market in transition. We'll keep covering these stories right through the period ahead, cutting through speculation and sticking to what's actually happening. If you've got thoughts on today's news, drop them in the comments, hit follow, and we'll be back with the next Daily Crypto Roundup. And as always, we will see you at the top.